Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. We're almost halfway through the year and global equity markets are up 13% so far in 2023. 6 months ago, concerns of stagflation and recession dominated. For investors, the experience of 2022 of both bonds and stocks falling in tandem was so enduring that bearishness was widespread at the start of the year. Additionally, the banking sector stresses in both US and Europe, debt ceiling fears in the US, and concerns of global corporate earnings recession have all added to the pervasive gloom. Yet, equity markets continued to climb the proverbial wall of worry and deliver strong returns as structural growth sectors performed well. Given the strong performance of equities already, on this podcast we take a stock of our macro base case and investment strategy for the next 3 months. Starting with growth outlook, global growth will likely hold up well over the next 3 months in our view. While some traditional yield curve related indicators point to imminent recession, we note that several other indicators, including strong job market, point to resilience. Broadly, consumer remains in a good shape. While manufacturing sector is stable, mini inventory correction is underway. Services sector continues to be strong across the board. A tight labor market is driving the need to automate and indirectly helping the medium-term growth in productivity. Yet, we acknowledge that uncertainties around the growth trajectory are plentiful. Turning to inflation, in absence of any major inflationary shock, disinflation process should continue over the next 3 months. Inflation could prove to be sticky in Europe, but in the US, inflation should start to surprise on the downside as movements in rental component turn favorable. Despite concerns, we do not yet see tangible signs of a wage price spiral. Long-term inflation expectations remain well anchored too. Now, on the monetary policy, we believe that the Fed is likely done with interest rate hikes for this cycle. However, we continue to see risks tilted towards a more hawkish Fed than to a more dovish Fed. To that extent, we do not rule out another 25 basis points to 50 basis points of rate hikes from the US Central Bank. European Central Bank and Bank of England have further tightening to do in our view. Bank of Japan should turn hawkish later this year. Thinking about the implications for asset classes, markets have repriced a more hawkish Fed. Yet, the uncertainty about the timing of the first rate cut is likely to be a source of volatility in financial markets, especially for bonds. Equity positioning has improved but is far from a crowded trade. While there is value in bonds over the long term, near-term trajectory is unclear. On the 3-month horizon, we continue to be overweight equities and underweight fixed income. Of course, the investment landscape is not void of risks. A sharp deterioration in global growth outlook owing to an escalation in unforeseen systemic risks, much stickier inflation needing central banks to turn more hawkish, and investor sentiment deteriorating rapidly are key risks to our positioning. Consumer health risks are also worth watching. In summary, with a 3-month view, we remain tactically bullish with an overweight in equities and underweight in fixed income, but continue to monitor risks to our base case view. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information regarding our strategic and tactical asset allocation frameworks, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. My name is Kishore Muktinutalapati, and I'll be back next week with another episode of Global Investment Insights.